everyone, welcome to the second episode of Hauscast. We got an exciting guest with us today, a mortgage broker and a good friend of my dad's.
Yeah, I've known Larry since 1988, would that be correct?
I believe that's correct, yes.
That's when we met. You were actually my manager at Robert Case Realty.
I was, yes.
Right?
Oh, no kidding. I didn't even know that.
Oh, yeah. Yeah.
From way back.
That's 34 years now.
Yeah.
34 years now. And then I believe you got your mortgage license in 96?
1996, yeah.
Okay.
Yeah.
Okay.
In-house at Case.
At Case, in-house, I do remember that.
You kept him in line, eh?
I did.
I think Case was one of the first companies where they actually had an in-house mortgage broker. Is that fair to say?
Yeah,
Larry?
I think so. If they weren't the first, they were certainly one of the first.
They were pioneers in a lot of things.
Absolutely, yeah.
Yeah.
Before that, it was just mortgage broker at the bank?
No, before that, you just go to the bank.
Oh, you just go to the bank?
Yeah, there was no mortgage brokers back then. Before there was, it Larry?
There were probably mortgage brokers, but none that sat in-house in a real estate office like we did. So
Yeah. Now, I believe you're with Premier Mortgage Center now.
that is correct, yes. Right? Yep.
And you've been with them for how long now?
I've been with them for a couple years.
Yep.
Before that, I was with a company called Home Guard Funding. Before that, I worked for Scotiabank. And before that, I worked for Case Realty.
When you worked at Scotiabank, actually, when we had our own company, Exit Realty, you were our...
I sat in-house.
You sat in-house, exactly.
that's
The go-to guy, eh?
So we go back a long ways.
Yeah,
obviously.
no kidding.
So I think Jeremy has a lot of questions as far as first-time buyers are concerned. Because
Yeah.
Jeremy works mostly with first-time buyers.
Yeah,
Okay.
understanding how to help them out.
So hopefully you can help him a little bit here. So go ahead.
Yeah, and some of the basics that, like, just as you mentioned, you've worked with banks like Scotia, now you're working as a mortgage broker. Like, what's the difference for someone to understand, like, how that works?
Yeah, that's a good question. So simply, if you're working at the bank, you have one employee and they have one set of rates and one set of policies. Working with as a mortgage broker, you have access to multiple lenders.
Right.
Some who may have guidelines that would fit the deal that you have, and some that wouldn't. So, you might get a turn down from Scotiabank, but find out that you qualify at a different lender like TD or First National.
Would that be like A and B lenders, Larry?
Not necessarily A and B, just simply the policies of each individual lender. Most banks are A lenders.
Right.
So when you talk about a B lender, we're referring to a lender who doesn't necessarily follow the strict guidelines of the bank. They are a little bit more loose with qualifying, the type of income you may have, things like that.
Okay.
And their rates may not be as competitive as the banks on a business, but they will be able to entertain different types of people who have different situations.
Yeah.
So I guess for me to understand that, with B lenders, you have more options basically, but the rates might not be as good necessarily?
Yeah, like I can give you an example if you want. So you may have someone who has recently had hardship financially. So if they were to go to a major lending institution, they may get a decline. They may say, sorry, your credit isn't good enough for us, so we're not able to lend you a mortgage. Where that B lender may turn around and say, well, you know what, we don't have the greatest interest rates in the world. We're slightly higher, but we can,
They can accommodate, right?
Yeah, we can overlook the fact that you've struggled for a little bit. And we'll do your deal for you just at a slightly higher rate than maybe TD Bank or Scotia or Royal Bank or whoever.
Yeah, that's good. You have options that way, kind of depending on what you're starting out with, right?
Certainly, we like to say there's a home for every mortgage. You just don't know where it's going to be.
Yeah. You got to explore your options in that sense, right?
Absolutely, yeah.
So for first-time home buyer and getting pre-approved, you're going through the process and seeing how much you're approved for. Is it smart for you to try to use as much as you're pre-approved for, or leave some wiggle room? Like, what's a good place for someone to kind of know how much they can afford?
You know what, that is also a really good question, and it really depends on who the person is and what their feelings are about what they're doing. If you're a commissioned person, you may not want to go to the maximum you're allowed to borrow based on your last couple of years' income, because you've seen the fluctuations in it.
Yeah.
If you're somebody who's a straight employee who's on salary and you know what's coming into the household, every month, then a lot of times you'll see them go to their maximum so that they can get the majority the
Most
of
money
what they want.
for the house.
Yeah,
Yeah.
for sure. Yeah.
Well, that makes sense, and that kind of plays into understanding whether you should go with a fixed mortgage or a variable mortgage, right? Like,
Yeah, you know what? Again, that's
Yeah, a lot of good
Yeah,
questions.
you got to be prepared for
and
this stuff.
There's really no correct answer for them. Unfortunately, a lot of people who are borrowing on a variable rate mortgage realize that there's a possibility that there's going to be a fluctuation in their payments.
Right.
The majority of people who get into those mortgages are people who have already had mortgages. So the first time you go out, you're a first-time buyer, you get a 5-year fixed term. And during that 5-year fixed term, you hear all the rhetoric about, that guy's rate is way lower than mine. And, and that guy's saving so much more money. So the second time around, a lot of people will then turn around and say, I think I'm less worried or less scared about fluctuation in interest rates. But that being said, it all depends on what you can lock into as a 5-year fixed term versus what's available to you as a variable.
Variable, right.
I find that if the interest rate differential between a variable and a fixed is 1% or more, people are more comfortable going into the variable. If it's closer, if it's only a 0.5% difference between a 5-year fixed term and a 5-year variable, there's a very good chance that the person's going to say, you know what, I'll take the fixed.
Yeah, it makes more sense for them.
Yeah.
And then, like, with the interest rates going up right now, would that impact people's decision on something like that?
Yeah, it does have them. It does have them, questioning themselves on what they should do. Right now, variable rate mortgages are well below 1% or more below the fixed term rates.
Is it that much? Right?
Yeah.
Yeah.
So even though there's some anticipation that next year there's going to be a couple of spikes in the variable rate mortgage, I think a lot of people are still turning around and saying, I'd rather take the 1.2% versus 2.75 or
Right.
whatever the rate is.
Yeah. Yeah.
Good.
Yeah.
Yeah, and I guess kind of talking about that, it makes me wonder about the government of Canada has some programs in place to help with mortgages, right? And for putting down payments down. I've had a hard time wrapping my head around how that works with the government and understanding how that can benefit first-time home buyers, because government loves saying that it's a great opportunity for them, but then on the other side, a lot of people saying it's not really helping you when you need help.
Yeah, there is a program. It's a first-time home buyers incentive program, and basically what the government is doing is if you have 5% down, they're giving you an additional 5% down to try to help you qualify for a mortgage that you're going to apply for. There are some substantial restrictions in it. The amount of income that your family can have. I believe they just increased it to $140,000 annual.
Oh, yeah? Okay.
Yeah, it was $120,000, and I believe it's now $140,000. The maximum that you can borrow is 4 times your income. So it kind of restricts the purchase price to around $500,000, which, Frank,
we talked about that. I mean, there's not too many places you can buy for $500,000 or less now.
Especially around the GTA.
The GTA
for sure.
or even Durham.
If you start getting into some cities that are in northern Ontario and things like that, there's a very good possibility. I'm not familiar with that market, but I would imagine that there are some properties that are affordable up there. What will happen is over the 25-year period, you have to give the government back the money that they loaned you, plus the same percentage of the increased value of the property. So if the house goes up $200,000 and they've given you 5%, then you have to within 25 years you have to give them back 5%.
5% of what they lent you.
Of the purchase price of the new value of the home.
Oh, at the end of the end of the mortgage.
Yeah. So at the end of 25 years, you must pay them back, or there are some different times when you have to. Like if you sell that property and decide to move the mortgage to another, like if you transfer the mortgage, or if you're just getting a new mortgage, you have to pay them then. Otherwise, you have to pay them in 25 years.
Okay.
Right.
And you're mentioning penalties or restrictions. Sorry, are there penalties associated? Like if your income increases, would that impact what you can do?
No, it won't, because you're already into that mortgage.
Okay.
If you
to qualify, you have to be under that amount.
Correct. And if you 5 years or 10 years in, you decide you're going to buy a new home and you're making substantially more money, that money that you borrowed from the bank or from the government, you have to pay them back. It doesn't get to roll over to the next house or whatever. Okay. So it's a one-time thing for you to do.
Okay, that makes sense.
It's really kind of complicated, but there are some different things like you would qualify if there's a matrimonial breakup. You're not a true first time buyer, but
There's some duress there.
You can now go into that program again, even
Right.
though you've owned a home before and things like that. There's several of them, but most importantly is the restrictions on the amount of income the household has and the purchase price of the property. They're the two things that are going to get in the way for most people in the GTA.
Okay.
That makes sense. So with that program in mind, is there other things that first-time home buyers could kind of look to do instead of going to this program?
So there are some other programs that the government offers. One is the first-time home buyers program, where you can withdraw under the home buyers plan, which is taking money out of your RSP.
Okay.
So if you've saved up some money in an RSP and it's been in the RSP for at least 90 days, you're entitled to take out up to $35,000 each for every buyer, and you can apply that as a down payment or any other costs associated with buying the property. It could be to not necessarily use as down payment. You could just be paying off debt to help get your loan
numbers in line.
ratios in line.
Yeah.
Or you can buy furniture.
Okay,
Appliances
so
and things
you're
like
not
that.
too limited in what you can
No,
do.
the only restrictions are that the government wants you to pay that back into your RSPs over a certain period of time, 15 years.
15 years, right? Yeah.
And if you don't start putting the money back into your RSP each year, they will add the 1/15 of what you've taken out of your RSP onto your annual income. And you'll pay tax. But when you take that money out of the RSP to buy the home or use it for any of your expenses, they will not withhold any tax from you.
Great program.
Yeah,
Right.
it is
Yeah.
a very good program,
Yeah.
and there's some ways to get around it so that people can, and especially this time of year, with the end of February usually being the deadline for RSP contributions,
Right. Yep.
you could put money into an RSP, leave it for 90 days, get a tax refund on 2021's tax return, and then use that refund toward
for your down
the
payment.
house. Yeah.
Okay.
Yeah.
No, that's
Yeah.
good.
But now would be the time to do it, because after February 28th, you won't get a tax refund for 2021. You'll be getting it for 2022.
22.
Okay, so it's like a window of opportunity.
Yeah, absolutely.
Once
for
a year, you
Yeah,
basically
for
have
sure.
to take advantage of that.
For sure.
yeah.
That makes sense.
Yeah.
Yeah.
And the other one is being a true first-time home buyer anywhere in the world. The Ontario government allows you to get a tax refund on land transfer tax, and it's up to, I believe it's $4,000 total.
Now that's only for the first time buyer then, right?
But that is, you must be a first-time buyer, never owned a home anywhere else in the world.
Anywhere else in the world?
Yeah, not
Okay.
just in Canada.
Okay.
So yeah.
Okay, so it's trying to clamp down a little bit on foreign investment in that sense.
Yeah, good question. I've never really thought about that.
The implications
way
of that, right?
thinking, but yes, if you're a true first-time buyer, unlike the other programs where, if there was a matrimonial split, or if you've owned a home before, but you haven't lived there, like if you had a rental property and you owned that for 3 or 4 years, and you've never lived in it, then you can buy under the home buyers plan. Take
Okay.
money out of your RSPs. You don't have to be a true first-time buyer for some of those other programs, but for the Ontario refund of your land transfer tax, you must be a first-time buyer.
Okay.
So can you stack some of these programs on top of each other as a first-time home buyer to kind of get the best bang for your buck?
So as a first-time buyer, you could do all three.
Okay. Yeah.
You could take 5% down payment out of your RSP. You could get the 5% benefit through the government and buy a house, the one where you have to pay them back.
Yeah.
And you could get the land transfer tax rebate. You can get all three of them.
Okay, so you can pick and choose the ones that benefit you the most,
For
right?
sure. Yeah.
That kind of helps you set yourself up, because we've talked about the market's a little silly, so anything to help people out right now,
Yeah,
right?
for sure. Yeah.
So,
Land transfer rebate, I mean, who's not going to take advantage of that?
Yeah, everybody will.
Right.
I mean, even when a mom or dad gets involved in co-signing for their kids, they can hold 1% of the property, and the kids who are first-time buyers can have 99% of the property. So they
Okay.
can get 99% of the land transfer tax rebate. Mom and dad wouldn't qualify.
Right.
But
yeah.
and mom and dad aren't really going to inherit the property in the event of, of passing or something like that. So the husband and wife or the partners that are buying the property, they would qualify under that program,
Sure. Yeah.
owning 99%.
Now, Larry, are you finding a lot of parents are helping their kids, i.e. refinancing their homes, getting lines of
co-signing.
credits?
Yeah, it's become pretty tough for the average couple or
Young kids.
or buyer. Yeah,
An
for
example
sure.
right here.
For sure. So we're seeing a lot of that, moms and dads who are gifting down payment to their kids so that they qualify, or coming on and bringing their incomes involved, getting their incomes involved to
Right.
help them qualify for what they're borrowing.
Yeah.
Regardless of who's paying, the banks and trust companies and things like that, credit unions, they just want to make sure that there's enough income behind the deal to support the money that they're lending.
But mom and dad are on the hook if the kids don't pay.
Everybody's on the hook.
Right.
Yeah. Whether
Yeah.
you're on title or not, if you've co-signed or if you're a guarantor on the loan, then you're on the hook.
Okay.
I was going to say, and you still qualify for those programs if you co-sign with your parents?
You should. Yeah, you're going to get the land transfer tax rebate if you're a first-time buyer, and if you're borrowing money, the household income may come into play on that one program
Maybe
where the
too high,
government.
right?
Yeah,
Yeah, with the
because you
parents
need to be
involved.
140 or less. So when you start getting into the millions of dollars for purchases, if the house is $1.2 million, you need a substantial income. You're not going to qualify for that program that offers the 140 income.
You got to find something around the 500 range.
Yeah, you're gonna need
Yeah.
three.
Good luck.
People,
Yeah.
you're gonna need 3 people to qualify for that one at 120 each or 140. Yeah.
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 No, that's not going to cut it.
Here's an aside, Larry. As far as when you break a mortgage,
Yes.
because I've been through this with clients before. They're with the bank, and they found out what their penalties would be, as opposed to being with a trust company.
Right.
Can you explain the difference? What they charge?
Yeah. So in all cases where someone has a variable rate mortgage, the penalty to discharge that mortgage before maturity is 3 months worth of interest. So
3 months.
3 months.
Okay.
And the reason why it's always 3 months and not calculated any other way is because the variable rate can change from time to time, and the bank has no way of predicting what that rate might be in the future. In the next 2 years of the mortgage.
Yeah.
If you had a 5-year mortgage and 3 years in, you decide you want to break it. So we don't know what the rate's going to be in the next 2 years, so we're just going to charge you based on that day you're moving. Whatever your payment is, let's just say if it's $1,000 mortgage payment, 500 of it is interest and 500 of it is principal. We're going to charge you interest times 3, $1,500. We'll break that mortgage. If it's a fixed term mortgage, it's a little bit different because the banks have made a commitment to an investor
Right.
who has put money to the banks, and the banks are now taking that money and lending it. So they will calculate it as either a 3-month interest penalty or interest differential, whichever is greater. You're breaking your mortgage, you're giving the bank back all their money. They now have to go and lend it out at a lower interest rate than what they lent it to you at when
Right.
you bought the property.
Yeah.
In the meantime, they still have to pay the person who invested in a GIC. They still have to commit to that money. They can't say, hey, Goofy,
Sorry.
Yeah, Goofy Frank changed his mind.
Don't sweat it.
And we can no longer pay Frank his interest rate.
Yeah.
Therefore, so those penalties could be greater.
They can be
Depending on-
substantial, right?
Yeah, for sure. I mean, it can be thousands and thousands and thousands of dollars.
Yeah.
People have probably read about it or heard Pat Foran talking about it when somebody phones up and says, "Hey, Bank ABC just charged me $15,000 to break my mortgage." That's because the money that they borrowed at it was substantially higher than what the bank can lend it out today. The monoline companies that mortgage brokers use, they don't necessarily use the same kind of money or the same ideas. So when they are breaking that mortgage, they are kind of just comparing the rate they lent it to you versus the rate that they're lending it at today.
Right.
And the Bank of Canada rate doesn't get involved in things like that. Some banks today, the Bank of Canada rate is 5.25%. Regardless of what your contract rate is, when they go to break that mortgage, they're going to look at 5.25%. right? So,
Yeah.
and then other banks don't do that. Other lenders don't do that. Other lenders say, hey, we lent it to you at 3, we're now lending it to you at 2. What's the difference?
Yeah.
That's what we're going to charge
Okay.
you.
That's where the big difference is then.
For sure,
Yeah.
for sure, because that contract that you sign with the bank, even though you're seeing 2 point whatever percent as your actual contract rate, the rate that the bank was lending you money at, the Bank of Canada rate at that time, may be substantially higher, and therefore your penalty will be substantially higher.
Gotcha.
So
Yeah.
it's a little confusing. Sometimes I don't explain it right. I confuse myself sometimes.
Yeah, no, there's a lot that goes into it, right?
Yeah, but for sure. I mean, they're not trying, like the banks, in fairness to them, they're just following their guidelines and doing what the paperwork says, right?
Yeah.
So it's unfortunate.
You signed on the
that
dotted line, and that's
Exactly.
those are the rules.
You're on the
right?
hook for it.
Exactly.
Yeah.
It's not always about rate. That's the key to it. Is
Yeah,
that
it's not always
sometimes,
about rate.
Yeah.
Yeah. And having said that, that's the advantage of using a mortgage broker who can explain those things to you as opposed to going into a bank that's an employed person
Yeah, for sure.
who doesn't perhaps have the best interest of the client.
I'll give you a perfect example of variable rate mortgage. You can get the same discount off of prime almost anywhere. They're all offering, say, 1% off the Bank of Canada rate prime. So prime is 245. So today everybody's offering 145. At any time during the 5-year variable that you're in, you can switch out of it if you don't want to be in it. But some lenders make you take a 5-year term, even if you've been in the variable for 4 years and you only have 1 year left. If you want out of the variable, you must take a 5-year term. Other banks would say, hey, you got 1 year left, so here's 1 year, here's 2 years, here's 3 years. There are the rates we offer. Pick which one
Some
you want.
options.
And maybe you take the 5-year term and stay with the new lender. But some make you do it, some offer you, and there are big differences in when it comes time to convert if you choose to do that.
Yeah.
So there's some of the things that a mortgage broker might give you a heads up on, so that you don't just say, hey, apples are apples, I'd rather be with this bank than that bank, so I'll take that one.
Yeah, it's understanding that it's, like you said, it's not just looking at rates, it's looking to the future of what might happen.
There's way more to it than rate. I mean, everybody's got competitive rates, and you might not get the absolute lowest in the industry, but there might be reasons why you're choosing not to take that.
You've got some options down the road.
For sure.
Yeah, trying to think of the future, right?
Yeah, absolutely.
Yeah. I've got one last question for Larry. I don't know if you have any other ones, but as far as appraisals these days, how are you finding with, for example, a house sells, well, I guess in this market it's not such a problem, is it? Or because the prices are going up.
Well, actually, it can be a problem. So, what I've seen as being the biggest problem with appraisals today and values based on people making offers over the asking price is, I think the definition of fair market value is what a willing buyer will pay, what a willing seller will accept, neither being under undue pressure to either buy or sell.
Right.
And that's how you come up with fair market value or true market value. The problem today is, who's under pressure when there's 14 offers? So even though we have a legitimate guy who says, hey, I think it's worth it and I'm willing to pay it, appraisers don't necessarily take that into as much consideration as they used to.
Okay.
When they would say, hey, you know what, the houses in the neighborhood have sold for this, and here's a guy who's willing to pay that, and he put it in writing, so
Are you seeing appraisals coming in lower than what, say, somebody who's bidding with 13 other people?
I'm not going to say no, I haven't. I don't see it often because usually everything is going up in price. So unless it's a one-off in a neighborhood, the trends usually indicate that the value is there. So I haven't seen some real problems. I would be a little cautious if it was a 5% down buyer and the property didn't appraise. The buyer would have to come up with the difference. The bank will still do the deal if the value comes in slightly less than what he paid, but they'll only go to 95% of that value.
So that buyer would have to come up with the difference, i.e. mom and dad.
Yeah.
Some way.
Yeah. So if somebody paid $1 million and they had 500,000 down and the property appraised at 950, it wouldn't really make a difference. We're well under the 80% loan to value that the banks are allowed to do.
Yeah.
sometimes we won't even see that appraisal. The bank will just automatically say, yeah, the value's good. Even though it may have come in at $1.1 million, it may have come in at 900. The numbers still work for the banks.
Yeah.
You know,
Gotcha.
But with the minimum down guy, that's the only danger in the bidding war. You know.
Yeah.
Is that do I have an extra $10,000 or $15,000 available to me if the value comes in slightly less?
Yeah, the importance of having some wiggle room for yourself, right? Mm-hmm. Just in case you get into that situation.
Yeah, for sure.
Oh, that's great. And really, I know a question that we've talked about that I'm not surely I don't understand fully is understanding when to refinance a place. Like when's a good opportunity to take advantage of that, or is it something you should try to stay away from if?
You know what, that all depends on what your plans are. I mean, if it's just to put a boat in the driveway, I would just say personally save your money. Yeah. Before you do it. But refinancing a property, when you do a refinance, you can only go to 80%. So if you bought the house with 10% down and you finance 90%, the house would have to go up substantially before you would have access to your equity. But for whatever reason you want access to your equity, that's really a personal or family decision to make. Yeah. If it's to send the kids to university, great time.
Absolutely.
If it's to pay off debt that's costing you money that you've
credit cards,
no problem, do it.
Yeah.
It's whatever makes the family comfortable. There's no right and wrong to that.
So in other words, we're not refinancing the house so we can go racing.
Yeah. Not yet, at least, huh?
Right. Yeah, but I mean, hey, listen. The best thing that anybody can ever do is buy real estate, right?
Yeah.
And the second best thing would be to buy a second piece of real estate. So if you're going to take money out of your existing property to use as a down payment to buy a second one, that's a good idea.
That's a wise decision.
For sure. Yeah. And it can't happen soon enough, though, based on the way the prices are going. Right?
Yeah, right? It's snowball effect right now if you can really take advantage of it. So
yeah, for sure.
No, that's awesome. Thanks a bunch for answering all the questions.
Thanks, Larry.
No problem.
A lot of questions.
Yeah.
And, pleasure.
I really appreciate you guys having me. It's a lot of fun.
Make it easy on us to understand what we're doing,
Yeah. Right.
Guy with the answers.
Yeah. Give me a shout anytime.
Thanks, Larry.
No problem.
Yeah, great stuff.
Cheers.
Thanks a bunch for tuning in. That was our second episode, and look forward to talking to you guys soon.
We'll see you guys again.